JP, I've got $100,000. Where should I buy? This is definitely one of the most common questions I get as a property investment buyer's agent. Now, why is it so important that we answer this question correctly? Well, it's often that first $100,000 that is the entry point to get into a mid-priced property, right? So a $700,000 purchase, that'll cover your 10% deposit, plus your costs, stamp duty, legal fees, etc. So we have to make sure that it's answered correctly. The reason why it's so important is because if you've just saved that first $100,000, then you're usually at the point where you're ready to invest in your first property, which will be your first foundational asset that is really, really important to set you up for your financial future. The reason why it's so important is because it is doing all the heavy lifting on its own. You don't have multiple properties building equity at the same time. You just have that one asset to rely on that is going to be the foundation for you rolling equity into building a portfolio long term. So most people screw it up. They go with their gut, right? They go and buy in their own backyard, in their own city, which can be the right decision, but it also absolutely can be the very worst decision you can make. It can cost you years of growth and tens or hundreds of thousands of dollars worth of gains that are now otherwise lost. I started my property investment journey in 2018. I built a $6 million portfolio before the age of 33 of 6 properties across Queensland, New South Wales, and Victoria. I've bought in my own backyard. I've bought elsewhere. I've bought houses. I've bought apartments. And I've made the mistakes and the wins so that you don't have to, or you can learn from me. And now I help other human beings, other people just like you, do the same thing. So in this video, I'll talk about how I'd approach it and ultimately where I would put that $100,000 if I had that saved today. But before we get into that, let's talk about where most people go wrong. Most people think that buying in their local area is safe because they know it really well. And that is the mistake that so many people make. They chase new train stations, infrastructure, where the nearest shopping center is, and these are complete fallacies, right? Sometimes they are true, sometimes they are not true. They are not direct correlators to capital growth. The other mistake people make is they think that cash flow or passive income is really, really important from day one. But the reality is that cash flow does not make you wealthy. Capital growth is the game. Cash flow just keeps you playing it. And if you focus on cash flow too early, you'll be doing yourself out of just that in the long term. For all intents and purposes, right now, you are probably asset poor and cash rich, meaning you have a job that pays you an income and you probably, or you maybe don't have a lot of assets. You need to take that earned income and funnel it into assets that are going to pay you and that are going to help you build wealth long term. Of course, I have to work out what I can comfortably afford to cash flow a property or properties out of pocket. But outside of that, my complete and utter focus is on capital growth. The other thing to note is that capital growth and cash flow have an inverse relationship. So generally what we find is that those growth areas or those capital growth locations have weaker cash flow, right? So their yields or their rental returns are lower, but their capital growth potential and their potential to grow in value are much higher. On the other hand, those cash flow locations or properties are going to pay you a very small, maybe a nominal sum every week or every month. They are not going to get you wealthy and they are not going to give you the growth that you're looking for. They might preserve your wealth, but they are certainly not going to make you wealthy. So ultimately, we don't want to be buying based on gut feeling, based on what Uncle Joe said at the barbecue. We want to be focusing on good quality assets in strong, low supply, high demand locations. So get on with it, JP. If you had $100,000 today, where would you go and invest it, or how would you decide where you invest that money? First and foremost, I would define my strategy. One of the biggest mistakes I see people make is they go straight into looking at the little red dots on REA without understanding what is the strategy. They'll just go and search a price point, look for good rental return, for example, and they won't look at their objectives, their goals, or their strategy, which is going to inform how they should approach it in the first place. So you need to work out your goals, your investment time horizon, how long do you plan to hold the asset for? You need to suss out your tolerance for negative cash flow, right? How much of a tolerance do you have for it, if at all? Right, if you need the property to be neutrally geared, are you okay spending $1,000 a month or $1,500 a month to cash flow that property if it is a good capital growth asset? Also working out how much of that $100,000 is actually going towards the deposit versus your costs associated with purchasing the property, and working out your overall strategy and borrowing or lending strategy with a mortgage broker. How quickly do you actually want to recycle the equity or pull equity out and rinse and repeat that into a new property? right? So one of the biggest things about property investing is your property grows in value, you extract some of that equity, the bank gives it to you in cash, and you use that to fund your deposit and costs for the next purchase. This is how property investors grow their portfolios without using any of their own cash. Also decide, do you want the family home down the track? When that would be, right? That determines how long you are planning to play the game for, the investing game, that is, right? And is this a one-off or is this the start of a portfolio, right? These things are all important to start off the bat as they will dictate your strategy. Do you want to be at work optional? Most people do. Do you want that financial freedom? And when do you want it by? That will help dictate the strategy. If you are 55, the strategy is going to look very different to if you are 30 or 25 years old. And it also helps us understand what that time frame looks like for us to generate those results. Without any of the stuff I just mentioned there, it's more or less like you're gambling. You're making decisions based on not a lot of information. It's when and only when this strategy is locked in that you can start looking at where you would put the $100,000. And from here, I would personally do something that not many people do. By the way, if you want some help mapping out your own goals, your risks and timelines, I've actually built out the investor questionnaire, which can help you do just that. It's the exact same framework I use for my clients before they buy. You can click the link below to get it right now. It's free, by the way. Let me explain how I do my research on specific markets. The mistake I see so many people make is they treat Australia as though it's one property market, or they paint the whole market with one brush. But the reality is the property market is multi-speed. There are multiple sub-markets and different things happening in different markets at different times. One of the key symptoms of this, or where people go wrong, is they follow the headlines, they follow the media. But that is wrong because they can only paint everything with a single brush, for the most part. So for example, Sydney might be peaking while Perth is heating up, or Perth might be heating up while Melbourne is just coming off the bottom, many things happening at the same time. So the goal is to find the warm spots, to find the markets that are just coming off the bottom. And the reason why this is so important is because this is what enables you to build equity quickly. Of course, property investing is a long-term game, but the idea is if we can build equity quickly and early, it means we can reinvest our gains sooner, making an astronomical difference to our long-term equity build, to our long-term wealth creation. So here's how I do my research. I'm analyzing house prices and looking at rental yields or rental returns across each state, first and foremost, to work out what I can actually manage to purchase and what I can manage to hold from a cash flow perspective. Then I'm looking at supply and demand metrics. I'm looking at the stock on market. I'm looking at inventory levels. I'm looking at hold periods. How long do owners hold their properties in those areas? All of these supply side metrics, as an example that I just utilized, will help us ensure there is tight supply. Supply is very difficult to fix. You can't just overnight fix supply, build more homes. No, it's a lot of red tape with councils. And then ultimately, once that red tape is cut, it then takes years for that stock to actually come to fruition, to get approved and to get built. I look at demand side metrics, of course, things like days on market, rental demand, right? Vacancy rates, to make sure that we've got a rentable product or a property that's actually going to be tenanted so that we don't hemorrhage money paying a mortgage with no tenants. We'll look at the renter to owner ratio. So one of the most important things is to have a very, very strong dominant owner occupier mix in any suburb or market that you're buying in. The reason for that is because if you have too many renters, that means a lot of landlords, a lot of investors. When you have a lot of investors, it is a supply risk, because if the market shits the bed, if the market goes through a downturn, investors sell their investments. They don't sell their home. If they sell their investments, supply floods the market, putting downward pressure on price growth. The other thing is that owner-occupied dominated suburbs just have a nicer appeal about them. It also means that people are coming in, buying properties emotionally rather than logically. They're coming to a suburb because they want to live there and they're happy to pay more than an investor normally would, which means stronger price growth in owner-occupier dominated locations. Another really big thing to look at is affordability as it relates to income. So income to house price ratio, ensuring that housing in a specific area is affordable for its own residents, for the people that live, work, and play in that area. The reason why that is really important, owner-occupiers make up 65% of property transactions as a whole. So if there is no local resident owner-occupier demand will fizzle out eventually. Investors cannot prop up an area perpetually or infinitely. Eventually, the demand has to come from the people that live, work, and play in an area, the residents, the population itself. That is why when I look at a location that has astronomically high house prices in comparison to what the people that live there earn, what their incomes are, that is a huge red flag. Because who is propping up these really expensive house prices? Because it's not the people that live there, I tell you. It's going to be the investors. And investor demand is dangerous because it's not true demand, right? It is external demand. we're looking for strong internal demand from residents. After we've done all this and we've looked at house price trends and we've looked at growth trends, we can also start to pinpoint at what stage of the cycle are these properties or these locations at. For example, if an area has been lacking in growth the last 2, 3, 4 years, but has had a good long-term growth trajectory, i.e. over maybe the preceding 10 years, it's doubled in value over a 10-year period, but then it's just tapered off the last few years, and affordability is very strong with decent socioeconomics, this is a really, really good sign that that market may be entering its new phase of growth, or to pay attention to it, that it could be entering its new phase of growth. Of course, we do want to factor in some other macro trends like infrastructure spending, population growth, government projects, the new hospital. These things are important, but they're not as important as people make them out to be. The supply and demand data tells a much more telling story. I'll give you an example. CoreLogic, or Cotality as it's now called, just came out with a report that talks to the growth in areas where the new Sydney Metro was built. What they actually found was most of those areas actually lagged in price growth after the Metro had been built. So a lot of this is really hype as opposed to fundamentals for growth. Keep that in mind. So let's just say I've done all that. I've factored in 2 or 3 growth markets that I think are actually the right locations or sub-markets for me to go in. Here's how I'm actually going to decide which type of property I'm going to target with my 100K to spend. So many people get sucked in to the shiny new builds, the sexy looking properties, or the one that they would love to live in, or the one that they think would look like their dream home. But let me make something very clear. Those properties do not make for good investments. In fact, they make for the complete opposite. They are the worst types of investments you could possibly buy. People think that new means better returns, or that high rental return or a rental guarantee is what is important when it comes to property investing. But they're missing the most important factor of all: capital growth. Louder for the people in the back. Capital growth. So yes, if you didn't realize already, I would be avoiding new builds, off the plan, new apartments, new house and land packages like the plague. Do not go near them. Veto, no, never again. Actually, not never again, because I'd never do that. Never have bought it. Never will. In fact, I know people that have been absolutely burned by those types of investments. Your focus should be on established properties. 80s or 90s build brick homes that have a strong land to asset ratio. Land to asset ratio basically means, say you were to purchase a property for $1 million, what portion of that $1 million are you spending on the land as a proportion of the total asset? So if you spend hypothetically $300,000 of that million on the land, that is a 30% land to asset ratio, or 30% of your spend has actually been spent on the land. But aiming for lots of land misses the point. It is about the value of the land in that specific area, as opposed to just aiming to buy a big block. For example, if you buy an apartment in a block of 6 in Coogee or Bondi, the land to asset ratio for what you're purchasing is actually going to be very strong, because you've got a small block in an area where land values are astronomical. Therefore, your land to asset ratio is probably really decent. Hence why you see apartments in the eastern suburbs of Sydney and the northern beaches perform astronomically well, versus say an apartment in Parramatta or in Westmead or in Merrylands or in Campbelltown. The land values are just nowhere near the same, which is why we don't see apartment values in some of those other areas increase whatsoever. So what would I be buying and where would I be buying it? As a general rule of thumb, in capital cities, I'll be looking at 500 to 600 square meter blocks on 80s or 90s build brick homes on flat or high side of the street blocks. Of course, no main roads, good neighborhood areas that have met all the fundamentals of supply and demand. When looking regionally, I'm more than likely going to be looking at 700 to 800 square meter plus blocks. And again, ensuring that what I'm buying is in original condition, 80s or 90s build type of homes that have been fully depreciated, stuff that I'm not spending my money on someone else's renovation or on their improvements to the land. Improvements is anything else other than the land, by the way. So above all else, established is better than new builds. Always buy established homes that are in somewhat original condition to ensure that you're spending as much of your dollar on the land as you can and very little on the improvements. My favorite way to illustrate this point is that I tell people, if I could buy vacant blocks of land and not go broke, I would. The only purpose that the house on the land serves to me is to pay me an income. Otherwise, I'd just buy vacant blocks of land. The land is what appreciates. Of course, something that has good bones, that's original, also has the ability for you to add value long term. So this is another great point, right? An original kitchen, bathroom, or something that needs a fresh coat of paint or floorboards or new carpets. These things always mean there is some additional upside for you if you decide to do the works and create some gains in a down market. One of the beauties of property as an asset class is that you're actually able to go in and force value. Even when the market says no, even if you're going through a downturn, you're actually able to go in and force your hand and make that property grow in value, or do what is called manufacturing equity into the property. Changing a great apartment in Sydney's eastern suburbs from a 2-bed 1-bath to a 2-bed 2-bath, right? Opening up the kitchen, living, dining to one open living space. You want to ensure that the asset is aligned with the local demographics and what they want to buy and what they want to rent. This is going to make resale a lot easier. It's also going to make it a lot easier for you to rent out that property. So now that I've locked in strategy, I've researched the markets, and I've even locked in the asset type or the property type itself. Now let's get into how we'd actually spend the $100,000. Here's a real example of how your process should actually play out from start to finish. We pick the strategy. So let's just say the strategy is focused on capital growth. We can stomach $1,000 to $1,500 a month out of pocket, and we want to hold the asset for 7 to 10 years before we decide to buy the family home. We then do our market research, and we see that according to the supply and demand dynamics, the socioeconomics and risk factors, Brisbane's outer ring seems to be in its early growth phase, and it's just come off the bottom at, say, 7 o'clock on the property clock. Just an example. We then do our research, and we can see that within those specific locations, we can buy 80s build brick homes that are sitting on 600 square meters, which are the perfect types of blocks, and they're not sitting in flood zones, they're not sitting in fire zones, and they represent very low risk on an asset level. This wouldn't be the case, as Brisbane has lots of character homes and not a lot of brick and tile homes. But you get my point. So now with that 100K, maybe I've decided that I can get into Southeast Queensland. I'm going to buy maybe in the Moreton Bay region, which is just north of Brisbane. That'll get me a $700,000 to $750,000 asset on a decent block size with the type of asset I want and with good capital growth. Now, this is just an example. I have just picked Moreton Bay or Southeast Queensland, plucked it out of thin air. In fact, it's actually seen an astronomical amount of growth, so keep an eye on that in the last 4 or 5 years. I bought a property in Brisbane in 2020 for $670,000. I just got it revalued. I'm pulling out equity. I just got it revalued at $1.22 million. So it's done an astronomical amount of growth in a short period of time. So be wary. That's my point. Smart investing is about picking your strategy, about understanding the market cycle, and then how the asset selection itself overlays on top of all of that. Notice how absolutely none of this is guesswork. It's all data-driven and due diligence investing, which is the right way to go about things. So if you'd like me to walk you through this step by step, feel free to book a call. In that session, I'll go even deeper on the methodology I use to purchase property for my clients, of which I bought 42 for in the last 14 months, as well as 6 of my own and a portfolio worth $6 million. Links in the description. So that's my process for turning $100,000 into a great foundational or an additional investment. But of course, even the best plan can get blindsided if the whole market flips on its head or if it turns. And of course, we've just seen the US property market has just taken a big hit. And the question on everyone's lips is, could Australia be next? In the next video, I'm going to run through exactly what's happening in the US. How does that relate, or not relate for that matter, to Australia? The signs you should watch out for here in Oz, and whether you should be worried or whether there's some opportunities to take advantage of. Click here to watch it now.